So day and swing traders often tell me that they'd like to have a strategy that they can devote a portion of their capital to that can be entered every week and gives them a high probability of winning. And those kinds of trades certainly exist within the options income discipline, but oftentimes these strategies yield very minor gains per week and overall aren't all that exciting. But there is a weekly trade that can deliver a high probability of success, a nice return in winning weeks, and the potential for exceedingly strong wins under certain circumstances. The great thing about many weekly options income strategies is that they can act as a nice complement to a day trader's and swing trader's strategies because they almost always win when the market isn't moving, which is the very time that day and swing traders might be struggling. So it's not a bad idea to incorporate weekly options income strategies into your overall trading practice. So if you think you might benefit from learning about a weekly options income strategy that would be easy to fold into your larger trading practice and has a nice probability of profit and the potential for very large gains in certain circumstances, then I think you should stick around and check out this video as it may prove very valuable to you. Hi, I'm Seth Froyberg, and I'm the head trader of SMB Capital's Options Trading Desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. So you'll want to click our subscribe button right now so that you don't miss any of our free trading videos produced for the trading and investing community. Okay, so what I wanted to cover with you today was a variation of what is known as the broken wing butterfly, which is a powerful options income strategy that's a favorite of options trading professionals. What's unique about our application in this example is the fact that we're applying this strategy for a short-term weekly trade, whereas more commonly options income trades are longer, say 30 to 60 days in duration. Now, this trade example involves the use of SPX index options. So for those of you new to options, we'll do a real quick review of how index options work. If you already understand index options, don't worry, this is going to be quick, and then we'll get to the trade example. Now, almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the S&P 500. You can't really buy or sell 100 shares of an index, but what you can do is get paid in cash, $100 per point, if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So, for example, if an index is trading at 1400 and you buy the 1410 call, if the index goes to 1415, you'd receive $500 in your account. If the index closes at 1409 or lower, your call expires worthless. On the other side of the ledger, if you buy a 1385 put and the market sells off to 1375, you'd make $1,000, but if the market just sold off to 1385 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will also allow you to sell options as well. And your broker will allow you to put together combinations of options. In other words, option strategies that involve both short and long options purchased in a way that's advantageous to you as a trader. So this weekly option strategy that I'm about to share is an example of that using index options. Okay, so let's first put this trade together and break it down so that you can see how it all comes together. Now, on August 30th, the SPX index was trading at around 29.35. So what we're going to do is create an option structure which will make money in a range around that price so that we don't need to actually make a prediction about the direction of the index. Instead, we're going to create a whole range of prices, both above and below the current price of the index, over which we'll win the trade. So we'll start to build this on the call side and find an options chain which expires about a week later to give ourselves a weekly trade. So we've selected the September 6th expiration, as you can see. So what we're going to do is go up 45 points above the market and buy 5 calls at the 29.80 strike, then move further up the chain to the 29.90 strike and sell 10 of those 29.90 calls. Finally, we'll buy as protection 5 of the 30.10 calls. So this structure is what is known as a call side broken wing butterfly. Now if we analyze it, entering into this trade will actually yield a credit of $160. That's because, as you can see, the cost of the 29.80 and the 30.10 calls is more than offset by the cash we receive for selling those 10 29.90 calls. So buying those 29.80 calls cost us in total for all 5 calls $27.45. Then we received cash for selling the 29.90s in the amount of $3,490. And then we paid $585 for those 30.10 calls, and it nets down to the 160 credit, as you can see from this calculation. So that takes care of the upside of the trade. Now let's turn our attention to the downside. So what we'll do is move down 45 points below the market this time to the 28.90 put, and we'll buy 5 of those. Then we'll move down 10 more points to the 28.80 puts, sell 10 of those, and then finally we'll buy 5 more of those 28.60 puts for protection. Now this structure is known as a put side broken wing butterfly, and it too actually creates positive cash flow for our account. So let's break down why the put side of the trade generated positive cash flow for us. Well, as you see, we paid $61.80 for the 28.90 puts and received $10,570 for the 10 28.80 puts. Finally, we pay $38.55 for the 5 28.60 protective puts for a total credit from the put side of the trade of $535. Now, bringing it all together, if we place both the call and put sides on simultaneously, we have a double broken wing butterfly structure comprised of an upside and downside butterfly structure. Now, for the entire trade, we have received a credit of $695, $160 from the call side and $535 from the put side. Now, options traders use analytical tools to create a graph of the potential profit of a trade, which in this case looks like this. And so this is one of the many cool things about this trade. As you can see, if the SPX index expires anywhere between 28.90 and 29.80, we just pocket that original credit of $695 that we got. Since your broker would margin you about $9,300 for this trade, that's more than 7% return in a week. And the reason you'd pocket the original $695 credit is because all of the options would expire worthless on expiration at any point between 28.90 and 29.80. None of the puts or calls that we bought or sold would have any value because at any expiration price between the highest put, which is the 28.90, and the lowest call, which is 29.80, all of the calls and all of the puts would expire worthless, whether we had bought them or sold them, which means that no one owes anybody any money on any of those index options, and we just get to keep the credit we received. Remember, calls only respond if the market expires above them, and puts only respond if the market expires below them. So in the case where the market expires between the highest put and the lowest call, then none of those options respond. That's why you just pocket that original credit. So now, most traders would be pretty happy with that outcome. 7% in a week is a tremendous return, but there's actually a far better outcome that can take place every now and then, which is why the profit potential of this trade is really substantial. Now, before we get into how this particular double broken wing butterfly trade would have ended up, I wanted to mention that we're currently running a 2-hour free intensive workshop at the moment. So if you'd like to learn 3 more real-world option strategies that our traders use, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video while you register. Or you could just head on over to optionsclass.com to register for this free intensive workshop. Okay, so now let's move forward to expiration day, and we can see that the SPX index closed at 28.94.10 that day. So let's think about the implications of that. Let's break it down option by option so you'll see the magic of butterfly trades. So let's take a look at how everything will cash settle. Well, it's pretty easy because on the call side, the 29.90 and the 30.10 calls are above the market, so those have no value. And all of the puts, the 28.90, the 28.80, and the 28.60 also have no value as they are below the market. So the only option that has any value is the 29.80 because that one is $4.10 in the money. And since we own 5 of those, we're paid 5 times $100 for each point times the $4.10, which is the number of points that call option is in the money, for a total profit of $2,050. But don't forget, we had that original credit from entering the trade of $6.95. We keep that no matter what happens. So our total profit on the trade is the sum of the value of the one call that's worth something plus our original credit for a total profit of $2,745. So that constitutes a return of 29% against the amount that you're margined. And that return takes place in 1 week, which obviously is an incredible return for a week. So what I'd like you to take away from today's video is the fascinating properties of the double broken wing butterfly trade. Not only would you make a 7% return in a week in a fairly wide range around the current market price, but you can also make a lot more if the market pushes past the highest put or the lowest call, as long as it doesn't go too far. In those circumstances, which do happen now and then, the return potential is incredible, as you can see. Now, just to remind you, as I said earlier, if you enjoyed this video and would like to learn 3 more real-world option strategies that our traders use, including a surprisingly simple strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit, whether the stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of the screen. That will open up a free registration page in a new window, so don't worry, you won't lose this video while you register. Or you can just go ahead on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Now, one more thing I'd like you to do is go ahead and click our subscribe button so you don't miss any of our trading videos produced for the trading and investing community. And while you're at it, please add your feedback in the comments section for what videos you'd like us to produce next, as well as what you found to be helpful from this particular video. So from all of us at SMB, trade well.